Imagine walking into a room where 9 out of every 10 people are destined to lose everything they've invested. The statistics in this game are more than just discouraging, they are a slaughterhouse. 80% of day traders are gone within 24 months, and after you account for fees and slippage, barely 1% ever see a dime of consistent profit. Most people watch a few TikToks, open a brokerage account, and think they've found a shortcut to freedom. But the market isn't a shortcut, it is a professional battlefield. It isn't rigged against you, it simply doesn't care about you. People fail because they bring a hobbyist curiosity to a professional's arena. And in this game, that is a recipe for a total account blowup. In this video, I'm pulling back the curtain on why the 95% continue to fail. I'm breaking down the 3 fatal pillars of psychological and financial ruin. And more importantly, I'm giving you the risk premium framework, the exact blueprint you need to survive your first year and move from the gambling majority to the disciplined 1%. Most beginners don't come to the market to build a business, they come to escape their 9 to 5. This creates a lottery mindset. Instead of looking for a repeatable edge with a 2-to-1 reward to risk ratio, they are hunting for the moon bag, that one hot tip or penny stock that will turn $500 into $50,000 overnight. When you treat the market like a casino, the market treats you like a gambler. Gamblers don't manage risk, they maximize hope. And in the financial markets, hope is a failed strategy. You aren't looking for a trade, you're looking for a hit of dopamine, and that's the fastest way to a zero balance account. There's a dangerous phrase in this industry, I'm just trading to learn. Imagine a surgeon saying they are operating to learn without ever attending medical school. It sounds ridiculous, yet beginners do it every day. They fund an account with real money and start clicking buttons, calling the inevitable losses market tuition. But here's the problem, the market is a terrible teacher. If you win a trade based on a bad habit, the market has just taught you that being reckless pays off until it doesn't. So you should be studying to trade, using backtesting, simulators, and deep theory, long before you ever risk a single dollar of your hard-earned capital. Professional traders practice in private so they can perform in public. We are living in an era of survival bias on steroids. Your social media feed is a curated gallery of Lamborghini traders, showing off $10,000 days and private jets. This creates a distorted reality where the beginner assumes that massive, fast wealth is the baseline. What you don't see is the silent graveyard. For every one influencer posting a winning screenshot, there are 10,000 traders who blew up their accounts, lost their savings, and quit in shame. When you compare your day 1 to someone else's, potentially fake, day 1,000, you force yourself to take unnecessary risks to catch up. You aren't trading against the market anymore. You're trading against an ego fueled by a mirage. Understanding the statistics of failure is one thing, but witnessing the how is where the real education begins. These behavioral traps act like a hidden tax on your account, starting with the classic FOMO trap. We've all been there. You're watching a chart and a massive green candle shoots up. You hesitate, telling yourself you'll wait for a pullback. But as the price screams higher, the fear of missing out starts whispering that this is the big one. Finally, you can't take it anymore, and you click buy at the very tip of that candle, only to realize that, like clockwork, you've just provided the exit liquidity for the smart money, who are now taking their profits. You didn't buy a breakout, you chased adrenaline. And as the price reverses, you fall straight into the certainty delusion. This is where the most dangerous phrase in trading, "this trade can't lose," takes over, leading you to ignore risk management entirely. You might risk 20%, 30%, or even 50% of your account on this one sure thing, moving your stop loss lower just to give it room to breathe while you watch your capital bleed out. You aren't trading a probability anymore. You're standing in front of a freight train hoping your opinion is strong enough to stop it. And while you're fighting this emotional war, you're likely suffering from indicator overload, staring at a spaghetti chart buried under RSI, MACD, and Bollinger Bands that are all screaming conflicting signals. This analysis paralysis happens because beginners use indicators as a crutch to avoid reading raw price action, searching for a magic signal that doesn't exist. At Risk Premium Academy, we know that if you can't read the price, no amount of colorful lines will save you. You don't need more tools, you need more clarity to survive the skirmish and live to trade another day. If you want to stop being a statistic and start being a trader, you have to move past the surface level noise and understand the structural foundations of the market. It starts with a shift in how you view every single tick on your screen. First, you must understand market mechanics. Most beginners think price moves because an RSI line crossed a level or a moving average turned green. That is a myth. Price moves for one reason only: an imbalance between buyers and sellers, driven by order flow and liquidity. Every price movement is a search for the next person willing to trade. If there are more aggressive buyers than sellers at a certain price, the market must move higher to find more supply. You aren't trading lines. You are trading the collective behavior and the urgent needs of thousands of participants. When you stop looking for magic signals and start looking for where liquidity is trapped, you begin to see the market's true intention. Next, you have to embrace the math of expectancy. The biggest psychological trap for a beginner is the need to be right every time. Professionals don't care about being right, they care about being profitable. In this game, you can be wrong 60% of the time, meaning you lose more trades than you win, and still build massive wealth. This is the power of a positive expectancy model. If your average win is $300 and your average loss is $100, you only need a 40% win rate to be highly successful. Trading is a game of large numbers. One trade is just a single data point, not a verdict on your skill. Once you stop trading for ego and start trading for expectancy, the stress of a losing trade disappears. Finally, and most importantly, you must prioritize capital preservation. The harsh truth is that as a beginner, your goal isn't actually to make money, it's to stay in the game long enough to learn how to trade. Your trading account is your inventory. Without it, your business is closed. Every professional trader you admire survived their first year because they guarded their capital like a fortress. They didn't swing for the fences, they focused on living to fight another day. In the beginning, your profit and loss statement is less important than your survival time. If you can protect your capital during the learning curve, the profits will eventually become the byproduct of your survival. We've covered the math and the mechanics, but now we have to talk about the arena where the real war is won or lost, your own mind. In this industry, we talk about the risk premium, the idea that you are compensated for taking on uncertainty. But to collect that premium, you have to overcome 1,000,000 years of human evolution that is actively trying to make you fail. It starts with loss aversion. Biologically, your brain is wired to feel the pain of a loss twice as intensely as the joy of a gain. This creates a devastating survival instinct in trading. When a trade goes against you, your brain treats it like a physical threat. Instead of cutting the loss and moving on, you freeze. You hold and hope, praying the market comes back to break even just so you don't have to feel the sting of being wrong. You turn a small, manageable business expense into a catastrophic account ender because your ego couldn't handle a tiny bruise. When that loss eventually does hit, and it will, it often triggers the second mental trap: revenge trading. This is the tilt that destroys even the best strategies. You feel like the market stole something from you and you want it back immediately. You stop looking at setups and start looking for a fight. You double your position size, jump back in without a plan, and try to force a win out of a market that doesn't even know you exist. This isn't trading. It's an emotional breakdown disguised as a transaction. Revenge trading is the fastest way to turn a bad day into a career-ending day. The only way out of this cycle is to realize that discipline is your true edge. Most beginners think an edge is a secret setting on an indicator. It isn't. Your edge is your ability to follow a proven plan when it is boring, when it is repetitive, and especially when it is painful. Professionalism means taking the loss when your system says exit, even if you think it might bounce. It means walking away from the screen when you've hit your daily limit, even if you feel lucky. To collect the risk premium, you must trade like a machine in a world full of people trading like gamblers. You don't need to be a genius, you just need to be the most disciplined person in the room. Trading is one of the hardest ways to make an easy living, but you don't have to navigate this minefield alone. If you're tired of the gambling approach, if you're done with the get-rich-quick noise and the hollow promises of perfect indicators, then it's time to start building a professional edge. By hitting that subscribe button and joining Risk Premium Academy, you're making a commitment to treat the markets with the seriousness they demand. This channel isn't about chasing the next hype, it's about mastering the math of risk and the discipline of the human mind. Every week, we'll be breaking down the strategies, the psychology, and the structural mechanics you need to survive the learning curve and thrive in the long game. Until next time, protect your capital, stay disciplined, and I'll see you in the next trade.